Okay, let's do a quick sound check, make sure that you can hear me. Just send me a quick chat. Perfect. All right, so Tony, let's just do a quick recap of last week's meeting since you weren't here for that one. We're just starting to do these, the financial planning crew, and so not a lot of people have been able to have had a chance to join yet. So I think for the foreseeable future, in the near-term future, we'll see increases over time. So let me show you what I got. Whoops, I didn't mean to do that. Okay, so last week we talked about anti-fragile income. And so with anti-fragile income, basically I'm just going to skip ahead of everything and just go straight to the final result. But basically with the anti-fragile income model is kind of designed to work like this. You trade with the apiary fund, and then you can take that money and you can flow it into your own actively managed account. See, with the apiary fund, it's a great place to learn how to trade, but it's not really ever meant to be like everything. So basically what the idea is, like, you take your earnings from this and flow it into your own actively managed account. And then what happens over time is, as you're trading, you're going to get gains. And so basically you're going to set a threshold as to how much in gains before I'm going to take the gains, I'm going to put it into a passive portfolio. So that could be things like insurance products or stocks, bonds, real estate, REITs, cryptocurrencies, precious metals, or even just banking products like CDs. Just depending on what your risk tolerances are and all that. So it could most likely will be a combination of a lot of those. So what you'll do is you'll be funding your own actively managed account by trading with the apiary fund. You also maybe take some of your W-2 income and put it into your actively managed account. And if there's any ways we can help you save in maybe if you have existing financial products that we can save you money, that could be directed into the actively managed account, or even just like your regular expenses. And so that's kind of how the actively managed account gets established, and then you get gains, and then it flows into the passive portfolio. And so that is, if you want a more detailed explanation of that, I would recommend watching on the crew page. You go to the crew page and just watch the first lesson of the 4 lessons. So let's talk about designing your plan. So this is where you're taking the anti-fragile income model and you are customizing it to yourself. Sorry, I couldn't see if the chats for a second, so I just want to make sure there weren't any questions. Okay, so what you're going to be doing here is you're going to be downloading a spreadsheet. So there's 2 ways to do it. You could just download it from the crew page, or you could go to this URL. It's traderonthestreet.com/AFIs for anti-fragile income. So once you put that in, that will take you to it's shared like Google Drive. It'll take you to Google Drive, and then you can just download the spreadsheet from there. So let me show you. Trader on the Street /AFI. So this is on Google Drive, and what you can do, what I would have you do here is you can open it up with Google Sheets, or if you do have Excel on your spreadsheet, or Excel spreadsheet software on your desktop, I recommend that. That's what I like to use. But if you want to use Sheets, that's fine. But what you can do here is you go to this little download button and you can download it because you can't really edit it here. So download it and then you'll have it, or you can open it with Sheets and then that'll open it up in your own Google account. So that is how you get the spreadsheet. So let's go over to the spreadsheet itself. What I've got here, don't worry about these errors here. These will all be fixed as we start filling things in. So we're going to start from left to right, and what we're essentially going to do is we're going to go through and we have like a list of expenses. And so when you're filling this in, I would think more of like what your goals are. Don't really put it in, you don't need to put in what your current situation is. But you know, if you have ambitions to increase your cost of living and do that, I would use the numbers that you would maybe be wanting to have in the future once you've got your trading down and you're making money and you're doing well with it. So I would say, because what we're going to do here is it's going to use these numbers to project out what amount do you need in passive income? I'm sorry, in a passive portfolio. What size of a passive portfolio do you need in order to cover the expenses that you're entering in here? So rent or mortgage, let's put in $2,000. Medical, I don't know, $500. Auto insurance, $100. Life insurance, you know, maybe you're paying $100 there. Paying off some debts, maybe you're paying off $1,000 a month in debts. Utilities, let's say like $100 a month. Phone, $50 a month. Internet, $50. Let's say you got an auto loans, $300. You're spending $200 in gas. And then maintenance, I don't know, pay like $25 a month. You know, you got your auto registration. Here in Utah, it's about 180, I think. So I'll do 180 divided by 12. I'm sorry, 180 per year because it's an annual thing. So I'll do, and so I just divided it by 12. Entertainment, you know, maybe I want to spend like $500 a month on entertainment. And let's say like I want to spend a couple $1,000s a year on vacation. So I'm just going to convert that from an annual to a monthly again. So that's 167. Say I want to give $100 a month in charity, maybe another 100 in gifts, and you know, $500 a month in groceries. You know, maybe you're paying $250 medical out of pocket. Any kind of subscriptions like Hulu or Netflix or Spotify or whatever it is. So let's put in like $25. So, and then, you know, whatever else, you know, and then if you want to change some things, some of these things aren't applicable, you could always change them. And then if this is not even enough, if like you really want to get detailed and this is not enough, you could always just add. So like, let's say you want to add a couple rows to this. So you would just like, I would do it in the middle. If you do it at the bottom here, it basically this here, it kind of takes a sum of all of these numbers. It won't include it if you do it at the bottom. So like, I wouldn't say like, move this down a couple and then start putting it because it'll still only include those. So I'm gonna undo that and just say, take like 2 of these and then you're just gonna insert. I'm gonna shift cells down. And now you have more spots and then you could be like, whatever it is, you put like $5 and $10 and you can see that that gets added to the total. Okay, so you do that, and then you also put in your monthly business expenses because this is something that you can treat as a business. So you know, you put in like your TOTS membership or Trader on the Streets. I'm sorry, I shouldn't abbreviate it like that. Trader on the Street membership. Let's say you wanted to do like one-on-one training. You know, maybe you do it like once a month or maybe once a week. I don't know. It's kind of up to you. So let's put in a couple $100. And then, you know, let's say you don't want to do your bookkeeping. Probably do it at first, but once you're making some pretty good money, I maybe outsource the bookkeeping. So maybe that's $100 a month. You know, it's really whatever it is. And so like business license, like here I'm in Salt Lake City, it's about $160 per year. So I'll put that into a monthly figure. Entities are in Utah, it's like $60 annually. So that's not a big deal. Tax filing, you know, we could, you know, let's say you want to go, this is basically what you're paying to have your taxes filed. So I don't know, like 350 bucks a year. So we're going to go 350 divided by 12. And so we've got $6,097 in personal expenses, and then we have $435 in business expenses. And I'll show you how these kind of get worked into the numbers. Okay, so let's say you are 30 years old and you want to achieve financial independence, and that's defined by having enough passive a passive portfolio, a large enough passive portfolio to cover these needs here in your personal expenses. So let's say, you know, the average age for retirement is around 62 years old, but you want, you know, this person wants to do it earlier. I want to retire early. So 50, at age 50, and they believe they're going to live to age 100. So that's 50 years of living off of a passive portfolio. So what do you need? So let's say your rate of return on a passive investment, it's not going to be very high. You know, it's probably going to be single digits. You know, some real estate, like REITs, like some of them can kind of creep up into the double digits. But let's just say about 8% is what you're going to get as a rate of return with passive investing. Now, remember, passive investing, this is you not having to do anything. You just place your money and it works for you, and you don't, and it just comes back. So it's not going to be that high of a return. So let's say 8%, and then, you know, inflation, man, this could be a problem. I mean, I just checked earlier, and you know, for June, the numbers are about 5.4% inflation. And the Fed is usually trying to do about 2%. So it's a little bit higher right now, and it could continue to climb, which is very likely, especially if we continue spending like the government has been doing. So we'll see what happens there. But the target inflation for the Fed is about 2%. It's been a bit higher. So I'm actually going to put it 3.5%. So hopefully in future years it will start going back down. And so we got 8% rate of return and a 3.5% inflation rate. So we want to be able to make sure that we're going to have enough money. So this calculation here, it calculates it for you. This tells you that you need $3,620,851 in order to do that. And that's in future dollars when you're age 50. So it's accounting for inflation and future dollars and all that. So that's how much you would need to have in order to say, I'm going to, if I'm able to get 8% and inflation stays below 3.5%, this amount will be enough to cover your living expenses found here for the remainder until your age 100. So 50 to 100, so that's 50 years worth. So $3.6 million. So that's a pretty good goal to have. Now, let's say this 30-year-old has some existing savings, so they're already kind of working towards this. And so let's say, but you know, 30 is still pretty young, so $75,000 maybe you got socked away. And then you can maybe afford to contribute maybe $500 a month. Let's put that amount in. So we've got the low threshold and the high threshold. So what these are is, this goes back to let me go back to this. Okay, so this is this right here, this line here, this would be like the low threshold. So this is like what the account size that you're starting with for your actively managed account. Then the high threshold is how much you want the gains to accumulate to. So Sean, for example, the way he does it is he starts with a $50,000 account. So his actively managed account is $50,000, and then he'll trade that until he's doubled it. And so once it's $100,000, he takes that $50,000 in gains and puts that into the passive portfolio, and then starts over with the actively managed account. So if I put those numbers in, so $50,000 low threshold and $100,000 high threshold. And if this is not making sense, please just put in a chat and let me know. And so you set those in, and I'm going to adjust these later to kind of show you how it works if you do different numbers. Then what we want to do is we want to come up with your daily target for trading. So every day of trading, how much do you expect to earn? So I look at Sean's Alveo when he's got it open sometimes, and it's always like 3%. I'm just like, I wish I could get that, but I don't really think that I'm a 3% trader, not at this point. And so, but you know, I think I could get to a point where I'm getting pretty good. Like a lot of people will do like 1% a day. It takes time and dedication and discipline to get to that. And I'm talking like what your average is. So you likely get more on most days, and then on the bad days, you kind of have to average it out. So let's just put in 0.5%. So 0.5% a day is your target. That's what you want to average. And then you have to figure out, well, how many days out of the year am I going to trade? So there's roughly 240, 250 trading days out of the year. Probably not going to do them all. So I'm just going to do a little formula here. Let's say I'm going to trade 5 days a week and I'm going to factor in, like, I'm going to say like for 2 weeks, I'm just not going to do anything. I'm going to be on vacation or whatever. So I'll take off that. So instead of 52 weeks, I'm going to do it for 50 weeks. So it's 250. So basically you're trading pretty much every day. I actually think this might be too much. So in future, I'm actually going to do 48 weeks. So 240 trading days, that's most of the trading days that are available. And so if you did that, you could expect, if you're getting 0.5% a day and you're trading 240 days out of the year, you could expect an annual return of 120%. That's a heck of a lot better than this 8%. So we have to kind of come up with what's the balance between the two. So this is going to be the main driver, your actively managed account into funding your passive portfolio. And then if you look down here at the years to the goal, it would actually take just about 18 years to get there. So that's good. I mean, I put a 20-year goal here, like from age 30 to 50. So it actually, with these numbers, 50% or 0.5% a day, 240 a week, that it actually beats the initial goal. So that's good. But you know, if you want to be a little more consistent, you want to get this kind of more around 220, I would maybe reduce the amount of days that you're trading. So let's say you're trading, let's actually knock it off. Let's say 4 days a week you're going to trade. There we go. So 4 days a week for 48 weeks. And so now you're only trading 192 days. You're going to get a 96% rate of return. And that's right about 20 years. So these aren't linked, but you kind of want to like manually look at the two, like in about 20 years and get that to a pretty close number. So they're about the same. And so between your actively managed account returns of 96% and your passively managed account returns, you're kind of getting an effective ROI of just about 20%, which people, like just the average person would kill for a 20% rate of return. Like if you're in a mutual fund or something, it's like, you know, again, you're maybe at like 10, 12%, something like that, in like an aggressive mutual fund, like a really high performing one. And so really just, I mean, they all have different objectives. And so they're obviously going to have different returns based off of that. But this is a very high return, about 20%. And so that's kind of how to do it. Now, let's just look at this part, the following parts here. There's not totally necessary because we're talking about goals for the future. But let's say you're wanting to kind of look at the cash flows and kind of come up with where is this money going to come from. So you're saying between your $6,097 that you're spending and then the $500 that you're contributing, you need to be able to take home at least $6,597 a month. And so that's after taxes. So what we have to do is we have to kind of work backwards and say, well, if I'm getting this amount in after taxes, well, what is the amount that I would need to earn before taxes? So we have to kind of figure out, like, and this is just going to be a rough number. Please don't use this as like as a totally accurate tax estimate. But basically what we're going to do is I'm going to say, okay, I'm a single guy, and so what will happen is I have a little there's like the tax tables over here that it will reference, and it will come up with, it'll say, if you're taking home $6,597, that's generally going to be because you've earned enough money that will get you in the 14.4% taxes for federal. State, because states are all different. Like if you're in like Florida or Texas or something, you know, there's 0%. They don't have income taxes. You would leave this as 0. I'm here in Utah, so we have a 5% flat tax. So you're just gonna have to kind of do your best. Like if you're in California, I mean, depending on what your income is, it could be below 5%. It could be like just a few percent, or it could be as high as like 12 or 13%. So depending on your state, you kind of have to manually put that in. And so it's easy in Utah because it's a flat tax. And then we're also putting your FICA taxes, because this is like a self-employed endeavor. Now, this is assuming you're paying the most amount in taxes. Like you talk to like an accountant or a tax attorney or something, they'll help you set something up that'll probably get you a lower tax rate than this. But this is like, I want to be conservative with it, kind of be like worst case scenario. So about 35% in total taxes being paid. And so basically we kind of take that, reverse it, and then saying, okay, so $6,597 a month after taxes. So you can see that that same number comes down here in your monthly. And then, so if you were to factor back in the dollars that you paid, that 35% in taxes, that means you need $10,083 a month in not gross, but like pre-tax net income. And then lastly, here we add in these costs, you know, the costs for your business expenses. Since these are fully deductible, you can just take it out from there. So this is this is your monthly gross amount, $10,518 that you would need to be bringing in to make these numbers work. Now you can look at an annual number, you can look at it annually, weekly, daily, however you want to do that. And then if you just drop down here to this last part, you can have different sources of income. So let's say you're working a W-2 job and you're earning, you know, like let's say $1,500 a week or $78,000 a year. And then like with apiary, this is kind of tricky because this is going to be a gradual thing. It's going to become more and more over time. And so if you're like, okay, I just want my job in apiary. So you would have to get 900, and I'm just going to round it up to 928 so that this number turns green. So you need $928 a week. Now that's pretty significant. And so that's not something that happens right away. So you would need an account. Like I'll just go down here and I'll say, we want desired monthly income. So we're going to put in 4,021 since 928 was for a weekly. So 4,021 is desired monthly income. And then your rate of return. So if you're getting if you're doing 0.5%, and you're trading 20 days out of and you're trading 20 days in the month. So that's that's a 10% rate of return. And then there's a split between the apiary and you. So let's say you keep 70% of it. That would give us an effective rate of, you'd keep keeping, that's what your share would be. Right, and so what we would need to do is we would say we're going to basically just take the desired amount that you want and then divide it by what you're keeping. And so then that, and we're going to convert that. So basically, you would need to grow your apiary fund to $57,443 in order to get that. So you'd have to be a 10% a month trader, and you'd have to have an account size about that. So, you know, if maybe 10% is like the ultimate, is like the goal, let's say you just do 5%. Then that means you would need to trade, you have your account size would need to be 114,886 in order to hit those numbers. So maybe that's not realistic at first. Maybe that's something that takes time. So maybe you want to kind of tamp down your expectations. Let's just drop it to 500, and then you could adjust that. So at a 5% trader, you would need a 61,000. So that, you know, it's hard to put this number in because it's such a gradual thing. But you know, we're trying to focus on goals here. You know, maybe you drove Uber, you earn a couple $100 a week doing that. Maybe your spouse has an income. So, you know, let's say she earns like $800 a week. So now we have a surplus. So like, well, 573. So obviously you don't really need to drive for Uber if that's the case. And you don't even need to earn as much with apiary. So you only need to earn 127 a week. Let's make it 128. And so, you know, there's a lot of different ways that you can get to meeting your gross revenue that you need in order to make all of these numbers work. And so this is not, like I said, this is not like totally necessary for this exercise, but these are just kind of ways that you can make some plans and figure out like, okay, what's the breakdown of my different sources of income, and how am I gonna, what's a realistic way to get there? And so, so anyways, that's this where we've entered in everything that we can at this point. So I'm going to kind of skip over here so you can see your actively managed account and your passive portfolio. So what happens here is you can see like, okay, so existing savings was $75,000. So you can see that $75,000 is put into here, but you have a $50,000 low threshold. So it's going to remove $25,000 right off the bat, and it's going to take that $25,000 and put it into your passive portfolio. So because that was the low here. So now if you were like, I want to do 75,000, then it wouldn't happen right away. But I'm just going to undo that and just show you that basically what happens is once you've hit your high threshold, it will, in the following month, it will take the surplus and put it into the passive portfolio. So you can see here, 56,694 gets taken out because you've exceeded 100,000, which is the high threshold, and gets put into the passive portfolio. So in the passive portfolio, you're getting rates of your gains here. These are based off of an 8% annualized rate of return, whereas the gains in your actively managed are based off of a 96% rate of return, annualized rate of return. And so you can see over time, because we're using averages, it's just going to be the same numbers every time. So basically what happens here is every 10 months or so, you kind of hit your threshold and are moving money over into the passive portfolio. So it's just kind of like this cycle that's going on over and over and over, and it just continues to happen until you hit your goal of $3.6 million. And so that's what this over here was. This basically kind of looks for this number. It's looking in the balance of your passive portfolio and just kind of scrolling down as you see it growing and growing and growing. And this is every row represents a month. And so about 3.6, so right here, so 237 months. So basically what it does is it finds that rather than you scrolling down and finding it manually, it just finds that number for you and then returns the amount of months that it took, and then we just divide it by 12 to get the number of years that it takes to get there. And so that's pretty much how that works. So you might be thinking like, okay, between my 96% rate of return and my 8% rate of return, I'm getting a combined of 19.7 or almost 20%, which is still really good, but maybe you're like, I want to kind of change, I would like to have it closer, I would want to get this benefit, the benefit of the 96 more in there, because this 20 is a lot closer to 8 than it is to 96. So what you could do is you can expand your thresholds. So let's say I doubled the threshold. Say my low threshold is 100 now, and now my high threshold is 200,000. So what you can see here is now it didn't immediately put money into the passive portfolio because we're starting out with 75. You can see that this grows until it gets to that $200,000 threshold. So this takes about 14 months to do that before you're funding your passive portfolio. And then it just kind of repeats again. So, and now we can see that we bumped it up from 20% to 28%. So that's really good. Now let's do an extreme thing. Let's just say you didn't really want to spend you didn't want to like be constantly moving money from your actively managed account to your passive portfolio. What you could do is I'm just going to make this into, I'm going to just raise the high threshold to above my goal. So I'm going to put 4 million as my high threshold. Oops, I put 40 million, which ultimately doesn't really matter. But so now you can see it never puts it in. It just grows in your actively managed account. So you're just growing and growing and growing. Now, the wisdom of this may not, from a risk standpoint, this might not be the most wise thing to do. But if you did do it that way, if you're willing to take on that risk of managing larger, like millions of dollars in a single account, in your actively managed account, because if you have like a really bad, streak of trading, and you have like $2 million or $3 million, and you lose like 10%, that's a huge loss. And so it's all kind of like a risk tolerance that you have to have. But just for the sake of showing you how it works, if I just did it and once I hit that number, it was above 3 points. The number is 3.6, and so okay, yeah. So I guess it does it a row later, but basically it takes 52 months, which is less than 5 years. In fact, it's 4.3 years. So you could hit this goal in less than 5 years if you did it that way. My column says year where it should say month. You're right. You're totally right. Thank you. Okay, fixed it. Appreciate you pointing that out. And so anyways, that's one extreme of going about it. You can just kind of grow your actively managed account until you actually hit your ultimate goal. Or you could do it in a more safe manner and just be like, let's say you could do like $300,000. You don't want to be spending, you don't want to have an active account much bigger than that. And so you can see then you get like a 32% rate of return. Any questions so far? Okay, Tony, so you understand everything you laid out? Not to the point I could repeat it verbatim, but the concepts make sense, especially taking on more risk versus, okay, well, good. That tells me that I did a pretty good job of explaining the concept here. So if for just like an FYI, if you want to look at this tab here, the retirement cash flow, basically this picks up at the date that you said that you retired. And it says, well, the amount, so basically we're taking that 6,000 in personal expenses, 6,097, and annualizing it and then inflating it for inflation, adjusting it for inflation. And so in 20 years, that'd be like 171,000. And then that basically continues on until you reach your age of 100, which you would be running out of money at that point. So this shows you your distributions. This shows the starting balance. This shows you your return and then the end balance. So you can kind of see that once you've hit that goal and the money is just fully in a passive portfolio, then you could, you see that like it continues to grow. And then about I think where it peaks about 6.6 million. And then we can kind of start seeing it, the inflation catches up with it and then eventually gets reduced down to nothing. So that you basically have just enough money to last you in your 99th year, and then it assumes that you die at 100. So that's just kind of does show you the cash flows after you've hit your goal. And so you can choose to continue to trade if you want, obviously. But basically, if you want to stick to these numbers, then this should get you there. And then like maybe if you have bad years in the passive, maybe you kind of make up for it by doing some active trading. And so that's essentially how it works. And so be sure to download this for yourself and spend some time plugging in some of the numbers that are applicable to you, and come up with some goals. And that'll help you to kind of determine like, okay, well, as a trader, what kind of percentage do I need to earn on a daily basis if I'm going to be trading a certain amount of days and I want to hit a certain goal, or like say, you don't want to contribute monthly, you put 0 and see how that kind of works out. You don't have to be making contributions if you have a starting amount. And so or maybe if you don't have a starting amount and you're, obviously if you don't have anything that you're starting with, then you're not ever going to be able to grow anything. So obviously there's nothing there. So, and maybe you contribute, $1,000 a month and then that shows how you can, how it kind of plays out, assuming the rates of return and the for your actively managed account as well as your rated or passive portfolio. So that's everything for this one. Yeah, good. I'm glad you're comfortable with Excel. It's a really good skill to have. Yeah, so whatever scenarios that you have and you want to put it in, and I'm happy, if you want to like shoot me an email and maybe we could you can show me what you've done and I can comment, maybe even do a quick little Zoom meeting together. I'm happy to do that. So yeah, be sure to spend some time, plug in some numbers that you think are going to work for you, and then we can collaborate and come up with a plan together. So that's it. That's all I've got for today. So I appreciate you guys coming, and I will see you hopefully next week.